Let me guess. There's a high probability that one of your New Year's resolutions was to buy a home this year. And you close your eyes, you wake up, and you're already halfway through July, right? Or maybe one of your New Year's resolutions was to save a little bit of money for a down payment to buy that house, maybe this year, if not next year, but you haven't because you can't catch a break, right? Home inventory has been low. Interest rates have nearly doubled this year. Home prices are still strong. Rents are still increasing. And not to mention the cost for everything has gone up. Home buyers are getting beat up left and right this year. And the popular question I get nowadays is, how are people still buying in this market? But before I dive into that answer, let's figure out where we are at. Okay, so early last week, the June Consumer Price Index, or CPI for short, was released, and that report gave us a ton of information on the state of the economy. Now, in a general sense, the report is a measure of how expensive everything is compared to this time last month and this time last year for goods and services. Now, the June CPI showed that the overall inflation increased yet again year over year to 9.1% compared to June of 2021, meaning that everything is more expensive and is 9 cents more expensive for every $1 spent. Now, it also showed that rents rose 5.8% higher year over year, or basically up $75 a month, assuming you pay $1,500 a month in rent, or get this, $116 a month more if your rent is about $2,000. And that is about a tank of gas right now. And it was even probably less than a tank of gas a couple of weeks ago, right? And rents are more than likely even higher, especially if you live here in Houston. Now, speaking of a tank of gas, you know that energy prices have been increasing all year long, up 42% this year alone, and up 60% compared to this time last year, right? Things are not looking great, right? But that's where we were at today. Now let's answer the question of how people are still able to buy a home with rising interest rates. Well, all the factors I just mentioned have a short-term dire outlook on the economy versus the longer-term happy outlook for the economy, right? And that short-term outlook is creating some opportunity for some savvy home buyers borrowing money, the dollar bills, in this environment. So with that said, shorter term fixed rates, hint, hint, are now well below the longer term fixed rates. So what does all that mean? Well, it means that clever home buyers are arming themselves with shorter term fixed options compared to their 30-year fixed cousins. And by arming themselves, it's setting them up for some home buying bliss. Now, wait just a mortgage minute, Ralph. Are you suggesting an adjustable rate mortgage? Those are snake oil loans. And that's pretty much the response I get. Well, let me tell you, arms are not the devil, Bobby Boucher. And before you change the channel and call me some type of loan huckster, just hear me out a bit, okay? So every homeowner that has a mortgage essentially has an adjustable rate mortgage. Now, the term at which the rates are fixed are different, okay? Even a 30-year fixed rate is adjustable once the initial term expires. It just so happens that the initial term is 30 years. And the main question is, why would you lock in the longest termed rate if you don't plan on being in your house for 30 years? So let's answer the question. How long do you plan to be in your house? 30 years, 10 years, maybe even 5 to 7 years. And even if you answer 30 years, you still might want to take a listen. Okay, so now both 30-year fixed and 10-year fixed arms are amortized over 30 years, meaning your payment with either option is based on a 30-year period by making regular payments on that borrowed money. So if both options are amortized over 30 years, and if your timeline is projected to be approximately 10 years or less, why would a calculating home buyer such as yourself lock in a rate till 2052 and not look into the shorter term 3, 5, 7, or even 10-year fixed rate options? As of late, the shorter term fixed rates are almost 1 full percent below where a similar loan profile would be compared to their 30-year fixed stepbrother. And that 1 full percent rate difference automatically adds some dollar bills to your bank account month over month and year over year. Take that, inflation. And matter of fact, commercial lending deals are wholly based on ARMs to give businesses the flexibility to pivot in this market as the market changes. Being creative, being keen, and flexible in this market will be key to accomplishing your goal of home ownership. Bottom line, with the rates expected to increase yet again in late July due to the recent CPI data, that's when the next Federal Reserve meeting is at the end of the month, couple days away, and the cost of goods and services still increasing, home buyers now have a fighting chance to arm themselves as we see real estate inventories slightly rise. Finally, looking into an adjustable rate mortgage could be a great tool to keeping your purchasing power high and your monthly budget low, all while giving you the flexibility you need based on your timeline in a home. That will do it for today. I'm Ralph Tapia. Thanks so much for watching. Stay tuned for my next video. And remember, I loan it so you can own it. Until next time. Oh, and if you plan to be in your house for 30 years, can you at least update the kitchen and bathrooms before you sell it? The home buyer in 2052 will thank you. See you next time.